So the excitement isn't going anywhere, with small business optimism remaining at near a 43-year high in February. But let's not forget big business either. CEOs are feeling the exact same way, with optimism among Americans' top corporate executives hitting its highest level since 2009, all of which is catching the eye of President Trump, tweeting, "Great optimism in America, and the results will be even better." Joining me now is Scott Martin of Kingsview Asset Management and Fox News contributor, and Jason Rotman of Lido Isle Investors. So, Jason, obviously they're optimistic about a change in regulation and possibly taxes being lowered. What does it mean if that doesn't happen, though?
Well, yeah, I mean, for Donald Trump to say the results will even be better, I mean, what other choice does he have? I mean, he has to say that. That's why the markets have gone up so much, is based off of that hope and promise, in a sense. I think the only major thing is that if these tax cuts really keep getting kicked down the road, in a sense, and they don't happen a month from now it's the summertime and they still haven't happened, I honestly, Melissa, I truly believe we're not going to see any major correction, even if that happens.
Really?
Because, yeah. I mean, maybe we go down 2-3%, but as far as like a 2008 scenario, I don't see anything that could possibly cause that. I think it's a very fundamentally strong economy. Deregulation is happening in the financial sphere. Possibly tax cuts will happen in the next 6 months. This is a very strong market right now.
Scott, do you agree with that? Because a lot of people are saying the way stocks are priced right now, it definitely feels like those corporate tax cuts are priced into their price.
Yeah, I don't agree, Melissa. I think the market is priced for perfection based on expectation. I think if we don't deliver, I think you're going to see a significant pullback, maybe to the tune of 15-20%. But the point is this. I mean, you let off with it. The small businesses, that's America. That's jobs. That's growth. These are the numbers that we've been waiting to see, as you noted, since 2009. So to have Trump being able to back some of his promises by actual real data that's coming out now will help to support stocks in the future.
All right, well, the Federal Reserve is set to meet tomorrow. It's all but expected to raise interest rates for the second time in 3 months. But is this an indication that they will move to raise rates even more than 3 times this year? Scott, I'm for one ready for rates to rise. I think we need to get back to normal. We've been in this extraordinary period now for about 6 or 7 years. Aren't you taking a little sigh of relief that rates might go up a little bit?
David, you're ready. I'm ready. The market is ready. I think that's really the big sign of the times here. I mean, look at how the market's reacted to the last couple interest rate hikes. We've been okay, at least considering that we'll get one possibly tomorrow. I'm not sure who to believe, though, when it comes to forecasting more clearly, either the Fed or the National Weather Service, because as remember last year, the Fed promised us 4 hikes. They knocked 1 in, and that was in December of last year. So to say we're going to get more rate hikes on top of this one is going to be totally data dependent.
That's true, Jason. They are chickens. They hate to raise rates at all. They're not Paul Volcker-like.
Well, the situation from a trading standpoint is that at some point the Fed will literally have to listen to the bond market. And, they say the stock market is more retail, the bond market's the real smart money. That's kind of what's a truism here. The bond market is saying the Fed's not going to be one and done. The bond market's saying that a major fundamental shift has happened. The bond bears are out. They're ready. We're going to have multiple hikes this year.
I think you're right, though. The market and the economy itself is stronger and ready to take it. Guys, thank you very much. Scott and Jason, appreciate it.